Good afternoon. Today we're going to talk about how to make money using a concept similar to how insurance companies make money. Now, nothing in this video can be construed as financial advice as I am not a financial advisor. Rather, this video is made for purely educational or even entertainment purposes. All right, so how do insurance companies make money? Well, insurance companies collect premium from many individuals insured, and in return, they pay some of the premium they collected to some of the individuals that suffer losses. So I've been paying home insurance for 5 years. I've been paying around $2,000 every single year. So I paid $10,000 to Allstate, and so far so good. Allstate hasn't paid anything back to me, so good for Allstate. But in the case that my home catches fire, then the insurance company is obligated to pay the agreed upon replacement price. I believe is several $100,000. Now, the likelihood of that happening, aggregate of all of the insurance paid outs is very likely less than the aggregate of all premiums collected. That's how insurance companies are doing so well. So today I want to talk about a concept using option trading that is similar to the concept I just described with insurance companies. Now, going forward, this video assumes that you have some sort of basic understanding of option, of calls and puts, buying and selling call and put options. If you don't and you'd like to learn more, leave a comment below and I'm happy to provide additional information on how to, what calls and put options are and how to buy and sell calls and put options. Anyways, so looking at the screen, this is a list of my current holdings. As of now, I have several QQQ call and put options. Today we're going to look at mainly the put options that I have. This particular put option is the way you read this is it's 326p means the strike price it's a put that I sold with a strike price at $326, and the 010630 means the expiration date is June 30th, 2010. I believe I bought this put option about a month ago, back when QQQ was trading at around $330. If you look up here, the current price, the price of QQQ on closing on Friday is $335.60. So QQQ itself has gone up $5.50 since I bought it. I'm sorry, since I sold the put option. When I sold the put option, I collected a premium of $10.11 per share. Each put option contract has 100 shares, so you multiply that by 100. I was given $1,011.31 in terms of premium, and in response, I have an obligation. If I get assigned, if QQQ falls below 326 at closing, on June 30th, if it falls below 326, then I have an obligation to purchase QQQ, 100 shares of QQQ at $326 a share. So my max obligation is $32,600 that I have to spend to purchase 100 shares. My max reward is the premium that I receive, $1,011.31. Now, this shows you how I'm doing right now after about a month. QQQ has gone up $5.60. The time premium component of the time component of the premium has depreciated because as time goes on, time always, is always in your favor when you're selling puts or calls, because as time goes to zero, ticks close to expiration day, the time value component of your premium approaches zero. So the stock has, stock moving further away from strike price also helps a little bit, but most of this movement here is due to time. And right now, with about 3 weeks left, it looks like the premium has gone down. If you look from $10.11 to $3.30. So overall, that means the total gain is, the premium have gone down by around 67%. When that, premium goes to zero, that means I collect all of the premium. Or, if I were to close the contract today, I would gain $681.31. Now, the other option obviously is to buy QQQ at the time I sold the put option. Now, at that point, as I said, the stock was at $330. So had I bought 100 shares, I would be up $560 right now as opposed to $681. Having said that, of course, QQQ could go to $400, could go to $1,000. There is no theoretical capped gain if I were to buy the stocks outright. But the likelihood of that happening, first of all, no stocks can go to infinity, and second of all, the likelihood of QQ going to 400 by June 30th, or some amount that's greater than $10.11 by June 30th, I calculated it to be less than 50%. And in addition, you have to keep in mind, if I were to buy it outright, I would have to pay $33,000. That's my maximum, expense. If QQ goes to zero, it's not. But let's just say QQ goes to zero, my maximum loss is $33,000. Here, I'm getting paid $1,011.31 to have the obligation of purchasing QQQ at $326. So my maximum obligation is $32,600 minus $1,011. Let's just say $31,600 if QQQ goes to zero, and the likelihood of that is pretty low. I'm sorry, the likelihood of it, QQQ further going down to $326 at the time I sold the put, in my opinion, was low. And this isn't financial advice, it's just personal observation. At the time, QQQ had been down multiple days. A lot of the big tech stocks were getting hammered. And, even without doing technical analysis, I felt that I was buying, 330 was at a bargain, 326. If I had to buy it, I would jump on it. So, I felt that was a good opportunity to sell a put. If it goes up, if it goes below 326, I'll buy it because I like it and I think it'll go higher. But I didn't think it was going to go below 326, so why not collect the premium? So what are some of the risks? In addition to assignment that I talked about, there's also a possibility of early assignment. Again, this is not financial advice. Just from my own personal experience, I've sold puts hundreds of times, and out of the hundreds of times, I think I've been assigned twice, and both were the Friday before, the Friday of expiration. So one time I think I sold Boeing at $100, and it was so in the money. It was $70. It was, and I got assigned. That's fine. The other time it was another stock that was also very, very in the money. So the likelihood of being assigned even at the money or a little bit at the money, in my own personal experience so far, has been zero. So there is early assignment. That's a risk, but hasn't happened to me yet. And I hope it doesn't happen to anyone else if you're not ready. If you don't have the capital. And lastly, like I said, your gains are capped. This is kind of like insurance, right? You get your premium. You're not going to get more than your premium, but the likely it's a judgment of risk versus reward, right? You don't have to pick at them. If you pick out of the money, right? That mean, and you pick a stock or an index fund that you want to hold out of the money, you collect some premium, and if there's a dip, you get to collect the premium and buy the dip. So I created a Excel spreadsheet of all of my gains and losses from selling puts. Unfortunately, Excel can't really take numbers plus words, so it came out like crap. But this year, I sold to open puts 56 times. And out of the 56 times, I was assigned 6 times. The other 50 times expired worthless. Now, some of them I had to roll out, but eventually they expired worthless. And I'll show you the 5 out of the 6 stocks that I purchased through assignment. So I got assigned Goldman Sachs, $300. That was my option. Sell to open, strike price 300, and it fell. I believe it fell to 290, 292. So I got assigned, and as you can see, I believe I collected two weekly premiums, or two premiums. I collected around $800 of premiums, and after I got assigned, it's gone up this much. So, not bad. Same with Lockheed Martin. I believe it was a 350, and I got assigned after a couple of rounds. Same with Lowe's, I got assigned, and also the last one I got assigned was ExxonMobil. So ExxonMobil, I'm actually losing a little bit of money right now. I literally, the last time I sold to open, I sold at the all-time high. So I'm down a little bit, but I've actually collected over $2,500 of premiums by selling Exxon over and over and over again. So net, I'm ahead. I'm trying to think. Oh yeah, you don't see it anymore. I was assigned Apple. I ended up selling it again, but I bought it again after I sold it. But I had Apple 115, and I got assigned, but it went up to 135. I sold it, and then I ended up buying again. But so those are my 5 out of 6 that I ended up making money. One I didn't make money was Merck. I got assigned. I just didn't, after looking at the financials, I decided to go with another. I decided to go with Pfizer. So I got assigned. I sold at a loss. So 56 out of 56 puts that I sold to open, 50 expired worthless, or I rolled and eventually expired worthless. 6 got assigned to me, of which 5 I'm making money, 1 I sold at a loss. I think that's pretty good percentages. I'm not saying that all percentages are going to be that high. In fact, how your likelihood of assignment, a lot of it has to do with, where the market's going, and more importantly, what stocks you pick. I mean, some people want to get high premiums, so they're selling GameStop at all-time high. They're selling AMC at all-time high, and to me, I think that's crazy. That's not risk averse. I mean, if you're going to be that risky, you might as well just buy some call options. But I pick major 500 big tech. I pick index funds. The likelihood of an index fund going to zero is probably nothing. I mean, if an index fund, if S&P goes to zero, you got bigger problems to worry about than than being assigned. So eventually, time is always your friend when you're selling puts, because the time component of the premium is always going to go down. You can't turn back time. So time works in your favor. And if you pick good companies, and if you pick index funds, if the market moves against you, you can always roll out. You can roll out, you can move, you can add additional time, and it'll increase the time component of the premium, and just sit and let time do its thing. I mean, I think I had to roll out 10 different times out of the 50, and out of about 10 times, eventually they all went to zero. And over the last few months, the market hasn't really, it's good, but it's not like last year post March good. So just let time do its thing, and eventually you will get to collect most of your premiums. Now, there's also a tax advantage to doing this, and I'll show this to you. I mean, I don't know what's going on with the current political, you know, the political landscape regarding long-term capital gains, but assuming, the current law stand, this is a, let's see here. Yeah, this one is a 2022 March 18 expiration put with a strike price of 310. I bought this a few days before March 18th this year, so um, the expiration date was more than 365 days. At the time I bought it, I believe I bought it at the money, so QQQ was trading around 310-ish. And the premium that was paid to me is shown here. $28.48 per share. I have 5 contracts, sold 5 contracts, so that's 500 shares. The total premium, max premium I could get is $14,242.42. It's been a little bit less than 3 months, and so far, yes, QQQ has gone up. This is 310, right? 310 is the strike price. It's gone up to 335, so it's gone up $25. And in the meantime, this put option, the premium has fallen from $28.48. Here's the current price, $16.70. It's gone down about 41%, and this is represented in the profit that I'm getting. And most of it, yes, some of it is due to price appreciation, which causes the price to move further away from the strike price. But also a lot of that is, time. Time also helps. So, after 3 months, I'm up $6,000, and I didn't put any initial capital in here. So I didn't buy any QQQ. I wasn't, I don't think I had 500 shares to buy. So instead I sold a put that's a year out. If it expires at just expires, then it would be more than 300 in 1 year, so it would be considered long-term capital gain. So it's a tax benefit, and worst case scenario, if QQQ goes below 310, I can roll it out. And keep in mind that I got paid $28.48 per share. So at closing, I mean, assuming that I hold it to close and I don't get early assign, for me to lose money on this, it would have to go below, it would have to be around $282 per share, because you subtract the strike price by this amount, and that'll be your break-even amount. So, QQQ would have to literally go down from 335 to 282 before I lose money on this. I think it's a risk versus reward. I definitely think it was worth it. And here I did something similar back in late May. I was selling, QQQ was trading around 320. I sold at the money, another 5 shares, a little bit more than a year out, and it's gone up what, $15, but the premium went down by 23%, and that's shown here in the gains. Worst case scenario, if it goes below 320, I roll it out. But overall, we all know that over a long period of time, stocks usually go up, especially if you have index funds. Index funds will very likely go up, a few percent a year, year over year. Now, one other risk I want to mention is how much do you sell? Because the safest thing to do is to sell cover short puts. What that means is, let's just say I have the capital to buy this amount outright. I have the capital to buy 500 shares of QQQ at 326. I have the additional capital to buy 500 shares at 310, 500 shares at 326, and then I sell the puts. So it's a cover short put because since you have the capital, there's no risk. Some people, what they do is they sell naked short puts. So let's just say I don't have the capital, I don't have the cash on hand, I sell these, and some people max out. Not financial advice, just personal advice. I hate going on margin. I strongly advise against maxing out because, what if something happens and QQQ goes down? You don't want to be the one, you don't want to be holding on to, $20,000, $30,000, $40,000 worth of risk. So what I typically do is here, I didn't have the, I don't have the cash on hand to buy 1,100 shares of QQQ at these prices. I have the cash on hand to buy, 400 or 500, but not all of them. What I personally do is I look at my total portfolio worth, and I try not to, this isn't, selling puts isn't going on margin, but assuming that, I get assigned right now, I would be going on margin. And I don't, the likelihood of that happening is very low, but if it happens, I don't want to be more than 20% on margin because I've seen what, getting liquidated do to people, and it's not a position that anyone will ever want to be in, especially if you're trying to take, this low risk, high reward position. If you've never done this before, my recommendation is start with a cover short put. If you got $30,000, $33,500 laying around, you might want to sell a QQQ at the money. Worst case scenario, you buy it, you collect the premium. If you have done this before, maybe you can sell more than what you have cash on hand, but my personal opinion, don't go crazy on this because last thing you want to do is you don't want to get liquidated. Anyways, hopefully this video has been helpful. I've been doing this many years, and over time, you're never gonna make the big money selling puts. It's not gonna be like the guy who bought GameStop out the money and made 10,000%. But you can collect, on top of your sound investments, on top of your calls, whatever option your futures you do, you can get an extra 10-15% a year at relatively low risk. And I think it's a worth the opportunity to at least look into. If you want to be more risk averse, go further out of the money, and you won't collect as much premium, but further or go cover short puts, and you can control your own risk, and you can collect premium, and more likely than not, you will make a little money on the side, and that money adds up. So, anyways, if you have any questions, feel free to write them down in the comment below. Happy to respond. Anyways, I hope everyone enjoyed the rest of their day and enjoyed the rest of their weekend. All right, take care.